morning, everybody. It's Tuesday, February 13th, and this is the AgYield War Room. I'm Dan Dempsey, and I'll be moderating today's session. As always, if you've got any questions or comments, please feel free to drop us a line in the chat area, and we'll be sure to get to those during the show. Quickly here, overnight markets had March corn up 1.5 pennies at 432. March soybeans were up a quarter, 11.93 1/4. And March Chicago wheat was down 4 1/4 at 5.93 1/4. Outside markets are currently sharply lower. The Dow's down about 370, and S&Ps are down almost 7 points. This morning, CPI data came out. Consumer prices rose 0.3% in January, which was a miss on the estimates from what they were looking for, about 0.2%. And the annual inflation rate was up to 3.1%. Most analysts looking for a drawdown in the 2.9% area. So once that report came out, outside markets started to shift pretty much sharply lower. A lot to get to here this morning, guys. We've got we're 8 days into setting the spring crop insurance price. Currently, corn is $4.74 1/4. Beans are $11.73 1/4. I know we've had a lot of questions, a lot of folks talking about the decisions between, whether it's cutting back on crop insurance or paying up and going for, some of these higher banded products. So I know we were going to talk about that a little bit here this morning. I know, Dustin, you've done quite a bit of analysis on some of these upper ended 95 percent type of policies, and just a couple of things to look out for and how you can analyze, making that decision.
Yeah, thanks, Dan. Yeah, so this market is obviously very tough. We're looking at below cost of production for both corn and beans on most of the university data. And when you get that, the general thought is, well, there's a lot of people that are trying to chase that through selling premium, right? Boxing themselves in, giving up certainty for the potential to get a higher premium through things like accumulators or short options. And, we would actually kind of lean towards the opposite, right? We want to create certainty where we have more insurance type of floor, whether that's puts or your crop insurance buy up, to just establish some sort of fail safe, some sort of, stop loss, make sure that this year doesn't go deep into the red, and that you have longevity. If we do see something come up in the markets, funds are very short right now, the ability to actually partake in that rally and sell into it needs to be there. And, closing yourself off with accumulators or real heavy sales, and especially prior to the seasonal window, that May, June timeframe, we think that could be problematic for some if they get too aggressive here trying to chase this market into the hole. So things like these 95% policies Dan's talking about, they have an appeal. That it's not always the best approach. It really depends on your own situation, your APH history, what part of the country you're in, type of ground you have. But we saw last year a lot of people went for those county-based policies, ECO. We were hot on the idea because we were dropping substantially after the price was set on March 1st. So we had a situation where just from price alone, we were likely to see payments if yields came in at the county averages. And so that was the big thing last year's ECO. I think that what Dan's alluding to here is that there are some personal buy-up band coverage levels that we're also looking at this year. And we've seen them in the past, when they say buy an extra 10% coverage. One company does it through raising their spring price. Another company will offer like a true 10% band. Whether or not you choose that harvest price option is also a consideration. It makes it a very expensive product to get things like that. But consider this, right? If we have we go to a 5% deductible with a harvest price option, what that affords for certainty, think of the years like 2015, 2016, those rallies were very, very short-lived. They were about 2 weeks each in those years. When we started off the year at 4, we got rallies into the mid-4s, and then it was just over for the year. Those were some of the hardest timeframes for us to get growers to market. because it was in the middle of a weather event. And I think that's where we come back to those 5% deductibles, is that, it doesn't take much yield loss if you have a good solid APH to be into a rising insurance payment. If that sale is too early and we get into a situation where the market keeps rising, such as like a 2012, we know the confidence of some of those policies will carry us all the way through, and we can test this on our profitability outlook, our matrix. But the point is that not all these products are created the same. A lot of them are riddled with limits of liability that you are, designed to kind of put their own stop loss in there. And so when you're buying a 95% buy-up, whether it's county-based, which has got, some of its own risks, or you're buying a personal buy-up, you want to make sure that you have really vetted it and know how it's going to perform in, a low yield, high price scenario, so that you know how easy it is to market around that.
Yeah, it does. I was going to add to that. We've talked about this a lot, but on paper, a lot of these look the same, and they're marketed as if they're the same product. And even on the crop insurance level or the agency level, the agents aren't in most cases aware of the differences, right? So when they're what they're being pitched by the underwriter is almost the same slide deck as some of these other products, but when you really dig into the math of it, they're very different, right? So it might not even be the agent's fault, because they're kind of using the slide deck prepared for them. But it's really important to really go through the numbers and the math of how it works, or give us a call if you have any questions. But they are very different, and I think there's going to be. We saw this last year even on some of these products where what they expected the indemnity payment to be and what it actually was quite a bit different. In some cases, tens of thousands of dollars or more. So to your point, some of them might look too good to be true or too cheap, or there's usually a reason for that. Their underwriters aren't dummies, right? So if it's a really cheap price and it looks way cheaper than the other ones that offered, they're probably a different calculation.
Devil's in the details there.
Yeah, and so just as a refresher, ECO is a federally offered policy option. It's a buy-up of 10%, which carries, you can easily get the harvest price option included there. It mimics your RP policy, but that is still a county-based product. There's always that chance that you have a dark cloud over your farm and not the county, individual perils. And that's the risk of buying those things, is spending, $40-50 an acre for Midwest ground to get that extra 9% coverage up to 95%. And yeah, I think it was a good idea last year because prices were coming in at $591 and we're falling substantially. I think the reasons to buy up a 95% policy might have changed this year, right? It's so that you have the confidence to sell, into the face of adversity, where I don't feel that as confident of saying that for an ECO policy, because there's no guarantee that whatever problems are happening that are causing that uncertainty are you're not going to be able to go back to hard data and say, I don't have any bushels in this bin, right, to prove that prove your case of why you need a payment. It's really based on how the county comes in. So,
yep.
Oh, that's really good. And, I think the ultimate takeaway too is to not get trapped, this year with, low volatility. Obviously we're coming off of a high cost of production. By all estimations, still costs are, historically high relative to where the market's at. Getting caught up in trying to trim back on something as important as crop insurance, could be, a fault, right? I mean, I think you got to still take a look at the numbers, and, it might be a good opportunity in a year like this to go pay up and get yourself some good coverage to start.
Well, Dan, to that point, we talk a lot with our clients about, there's a lot of tools available. And I think sometimes people look at like the one tool that's going to be the best in any given scenario. And it really changes year to year. You look at a lot of factors, and we've talked about this, but like option vol, for example, is at like 3-year lows, right? So those aren't the times, to Dustin's point, to be selling premium and taking on additional risk for a small premium. It's a time to be buying volatility, whether you're bullish or bearish. It's relatively cheap. So whether it's, buying crop insurance, which is a form of a put, right, or making sales and buying calls, like options are relatively cheap, right? When they last 2 years, they're historically high. That's when you do accumulators. That's when you do things where you're selling that premium. So it's really about, to Dustin's point, ECO was the thing to do last year. It might not be the thing to do this year, and most likely isn't. Usually what worked last year doesn't work the next year, and vice versa. But because of how people remember things, they tend to do what they should have done last year this year. That's been going on for generations. But
yeah, and I think it's also just because there might be people that haven't heard this before, Justin. But a lot of times, I think the focus on these higher level products is, what are my chances of payment? How much am I going to get paid for this? And largely, crop insurance is one of the worst types of insurance for getting a payback. It's got a low loss ratio for insurance standards, because we keep seeing higher and higher trend yields, and markets tend to not move that far a lot of times. I don't think that the tangible payment of crop insurance is ever what we are expecting. It's the ability to maneuver. It's the intangible things that we can do around it. The 2015, 2016 rallies in that example I gave, if you were just to go get more aggressive, and that extra, small deductible allowed for that to happen, the marketing a lot of times we think will make up for it. The ability to sell in the face of adversity, that's the real value of the insurance, not the expected payments from it.
Absolutely. And you're readjusting your guarantee on your own. You don't have to wait for the harvest price. It's basically what we're doing, right? You're buying the guaranteed bushels, another way of saying the deductible, and you're buying that, and instead of a 470 price, if you rally to 570, you're adjusting that guarantee yourself by marketing against those guaranteed bushels, right? So I agree. That's always the power of crop insurance. Unfortunately, it's misused a lot and sold as odds of payment, versus, to your point, I mean, that's a way bigger benefit for sure. The marketing aspect of it,
No, absolutely. Good stuff there, guys. Got a couple minutes here. Ryland, what do you got for us on the meats?
Well, it's pretty quiet so far this week. Just a little bit of weakness here in the live cattle market and the hog market. Feeders were up again. So just kind of coming into the day, there just wasn't too much news to really chew on. It still feels like the roll is going on right now. Open interest. Pretty big up here in April and June on the live side, and same thing in the feeders. We're seeing a roll out of the March and into the April. So cash hasn't really produced any big results this week. I think there was a little bit of light cleanup in Iowa, around 286 for dressed. So no live sales yet. I think just at this point, there's a little bit of caution with the price action doing what it's doing, and the lack of fun participation right now. It just feels like it's kind of light. So we kind of need something outside of cash, I think, to really kind of get us whooped up. We're kind of past all the supply reports for now that would really make a big longer term impact. But we do have a cattle on feed report coming up next week. So I think that's going to be a little source of caution here. So I wouldn't be surprised if you got a little bit of hedging activity this week, just because prices are back up. We're in a really good spot. We're trending higher. All the news is good. So they're just really, it's kind of stay the course right now. And as far as hogs go, they've been on this little bit of a downswing. Looks like things are trying to stabilize. We saw bellies about $5 higher yesterday. Hams about $5 higher. So the meats is staying pretty strong right now. This is typically a good seasonal time to start looking at marketing too. Just getting a couple forward sales on, just because we're already starting to hit these really kind of important seasonal time frames. So without trying to outguess anything, may want to start looking at some nearby margins and some forward margins, just to see if maybe making some sales up here is a good call.
Oh, very good. Appreciate that, Rye. We just come into the open here. We got March corn trading about unchanged, 430 and a quarter. March soybeans are down to 1190 and a half, and March Chicago wheat down 4 now at 593 and a half. Every day that the markets are open, 8:15 Central Standard Time, we are streaming live on X, Facebook Live, and YouTube Live. Appreciate everybody's thoughts and comments here this morning. One thing to point out, I know we talked a lot here this morning about crop insurance and those type of products. If anybody's got any questions or wants to elaborate a little bit more on kind of some of the things that we've been visiting on, please don't hesitate to reach out to us. The number's up there on the screen. You can also reach us at info@agyield.com. We'd be more than happy to visit with you and talk about your individual situation there. So appreciate everybody here this morning tuning in, and we look forward to talking to you tomorrow morning. Have a great day.
Thanks, Dan.
Thank you.